Good morning and welcome to the Open here on BNN Bloomberg. I'm Roger Peterson. Thanks very much for joining us. Let's get to some of the stories now we're following in the BNN Bloomberg newsroom. Canada's merchandise trade surplus grew in April to its largest in more than a year, driven by higher energy prices. The country posted a goods trade surplus of more than $2.7 billion, beating analysts' expectations. Exports increased by 1.6%, driven by the U.S. market. Canada now has a nearly $9.5 billion surplus with the U.S. Bombardier is investing $78 million to expand its Singapore maintenance and service hub. It's to support an anticipated increase in the number of business jets. The private plane maker says there's a record backlog for it, surpassing $20 billion. A tenth of that comes from the Asia-Pacific region. Construction will begin in the second half of this year, with operations starting in 2028. Cineplex says it had its highest May box office since 2019, bringing in more than $60 million. The company credits a diverse film slate that drove audience engagement, especially among younger moviegoers. This includes movies like The Devil Wears Prada 2 and Michael. It says Michael is the highest grossing music biopic of all time, surpassing $300 million at the box office. And taking a look at the markets, looks like the U.S. Market's bouncing back from Friday. Update yesterday, another update today, reacting to the news from the U.S. The stocks are, the Micron is up, and other AI chip makers seeing a resurgence right now. You got the NASDAQ up about 0.87%, the S&P 500 by about a half point. TSX, taking a quick look at that. End of the day up yesterday, but a little bit of a pullback towards the end of the day, but still up for the day overall. Oil right now, let's see where it's heading. And WTI, it's down by about 2% on that news. To Trump talking about there may be a deal possibly in days and everything will be resolved. We'll have to wait and see. Of course, gold, it's been a bit of an upsurge, but now it's almost a wash right now, up by 0.05% and still below 4,400. Taking a look at the Canadian dollar, and up slightly 0.21% at 71.82. And last but not least, although a little bit least right now, it has been taking a hit. Bitcoin off by 1.36% at 62,605. It has been slumping for this year. Chip stocks are rebounding for a second day. Oil prices are pulling back on the hopes of a U.S.-Iran deal. U.S. President Trump says the peace deal could be finalized in the next 2 to 3 days, paving the way for the Strait of Hormuz to reopen. Let's get some perspective from Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. And I saw you nodding your head at Bitcoin as well. It's taken a hit. And thanks for joining us, as always.
Thanks for having me, Roger.
We can talk about Bitcoin because you were nodding there, but the U.S.-Iran deal, is it just the latest talk? What do we do with this?
It's going to get done. And I think oil's telling you that. Gold's telling you that. I think the more profound question is when the deal gets done, how quickly does oil drop? And what does this new world look like? And do we get a peace dividend which supports multiple expansion within the markets? And so they're going to cut a deal. The president's got to cut a deal early enough because we got the midterms. Iran has been decimated. So, they're just finishing some things off. So I've always been of the point that they're going to get a deal. What does, investing is about, Roger, 14 to 18 months out. What does that look like with the deal done?
And I mean, we've had several of these. We've had deals done, it's coming, the deal done is coming again. And we keep hearing those. When do the markets start going, well, maybe this one's not the one? When do they start worrying a little bit about it? That this may drag on far longer than maybe ending now? Yeah,
it's interesting because that's the consensus when you hear the pundits, the deal's not going to happen. What I would say to you is when I look at gold, I look at oil, and I look at the yields in the credit market, that kind of, I get to be able to look at the world without listening to the noise. Mm-hmm. Look, if he doesn't cut a deal, yields go substantially higher, and that's a big problem.
Yeah.
Okay? and oil goes substantially higher, and that's a big problem. The forcing function in all of this, Roger, is we have extreme levels of debt, which is forcing the economic strategy of the United States to change. It's forcing the global economic strategy to change. So a deal has to get done. That's my point.
And so you do feel this one could be the one, like we're pretty close.
Oh, he's tiring me. Is it this one? Is it that? It's going to get, I would say by the end of the month, we're going to have a deal. How does that sound?
All right. We'll hold you to it. No, I won't hold you to it. I mean, who knows? It's likely, and I mean, I agree. I think they're all spent, and they all have some political repercussions in their own countries that they need to start thinking about.
Yeah, and this is the first time I've ever seen a massive international agreement been negotiated through Twitter or X. It's just amazing.
It's a different world right now, isn't it? When it comes to that. Okay, so if the Strait opens. We're not back, but it's going to take months, if not longer, to get back to normal.
I think it's going to happen quicker than people expect. Oil goes down quicker than people expect. Then here's the big bugaboo that everybody, interest rates are going to go down. I know the I call them the Keynesian on Bay Street and Wall Street want rates to go up, but rates go down. And then for investors, what does that mean about your portfolio? Given the fact that everybody's been riding the AI wave, which is a secular growth theme, do we get the other side of the economy going, this cyclical side of the economy going in the United States? And I say yes, because what Trump wants to do is run the economy hot, which means Main Street, which is the real part of the economy. And I think when you look at the transports right now, I think in Canada, look at CP Rail, for example, you're starting to see people positioned for that trade. So AI won't be the only trade in town. Rates come down, it's going to shock everybody. And when we talk about at Wellington is how do you position your portfolio for that type of environment?
And if we see this, it's not necessarily a rotation, just more a diversification of people doing what to do with their money. And most of the earnings reports have been good, if not great. So those numbers are solid. And have they been tempered a little bit by what's unfolding in the Middle East? And if there's a deal, we'll see that the markets will actually really react to those earnings reports?
Yes, because we have 16% earnings growth, right? Maybe 15. Here's the secret. Earnings grow at basically nominal GDP. So we have David Dodge out the other day finally recognizing the fact up here in Canada there's going to be no growth for 2 years. But if in the United States, growth is going to pick up. And they're going to run it hot, which means earnings growth is going to be above historical norms. Overlay AI on top of that, a productivity phase, and you're getting earnings growth 15, 16%. Roger, I'm assuming 10 to 12% earnings growth from here to 2031, which is where 100% tax deduction of CapEx goes away in the States. You get $650 of S&P earnings. You put a 22 multiple on it, put a 25 multiple on it. The point is, 1650 on the S&P is doable in this era. And what we've got is Wall Street and Bay Street are using the models of secular stagnation coming out of the global financial crisis, and we still haven't seen a pivot. I mean, the reason I'd say that too, we were joking, is, look, there are people that still think that a strong job market is inflationary. That's classic Keynesian dogma. So we haven't had that psychological shift. Tiff Macklin definitely hasn't had that psychological shift. We're up here talking about whether or not it's a recession or not, where the bigger problem is, look, an economy can die many different ways. And when you look at a recession, that's an economy is dying by a heart attack. That's what C.D. Howe was saying. And I'm saying to you, the economy has died through cancer, long-term rot, okay? And up here, we've got to sit there and be honest with ourselves. And so when you talk about at Wellington with our clients and our teams, we sit there and go, well, up in Canada, when you look at the TSX, you look at a company like Royal Bank of Canada, excellent company, well-managed, world-class. It's trading at 3.6 price to tangible book. Roger, anything above 2 is expensive. Roger, Bank of America is trading at 1.6. Are we all going to pile in to banks up here? And so the real question I have is the Trump derangement syndrome that we have up here has amplified and supercharged the home bias. And if we have, finally, former governor, Mr. Dodge says, let's be honest, no growth up here. Okay. There's going to be no earnings growth up here. So are we all going to just pile into the banks? Because we just saw gold and oil rolling, right? Massive chunks of the TSX. To me, that's the risk. And risk is perverse up here. So do we get that? And look that's a psychological question, not a fundamental, Excel spreadsheet question.
All right, I want to get to a couple stocks you're liking right now, or we're looking at. Eli Lilly.
Yes. Lilly, first off, it's the obesity drug, but I think people have got to start thinking about different ways that AI can manifest. And I think what you're going to see, a lot of people say, if we live 5 more years, Roger, we're going to live to, 200 because they're going to cure all the diseases. That is AI getting into big pharma. And I think the best way to do that right now is with Lilly.
All right, Micron, which is enjoying a nice surge today.
Yeah, well,
after a big drop on Friday.
If this cycle is longer than we expect, right, which is key, and I am in that camp, then Micron is trading at a very, very cheap multiple because there is an old view that memory is the crappiest part of the semiconductor cycle. Well, if you listen to Elon Musk and Jensen Huang and all these people, memory is the place to be. So do you get a company that's significantly undervalued historically trade to a market multiple? So if market multiple is 20 and you can get $150 of earnings in, let's say, 28, 29, Roger, that's a $3,000 stock.
Okay, we're going to wrap it up on that note. Jim, always a pleasure having you in, sir.
Thanks
Appreciate
for having me.
Always nice to see you in the studio. Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Coming up, Chemtrade Logistics shares are up nearly 50% from a year ago as demand for its chemicals sees robust demand from Canadian municipalities and from the tech sector. When we come back, we'll hear from the company's CEO about the strong performance and what's ahead. Chemtrade Logistics, the Canadian industrial chemicals company, is a leading supplier to global makers of advanced semiconductor nodes. It also supplies water treatment chemicals to more than 1,000 cities across Canada and the U.S. And the company expects these segments to be key drivers of future growth. For more, we sat down with Scott Rook, President and CEO of Chemtrade.
We have recently upgraded our quality levels at 2 out of our 3 ultra-pure acid plants in the U.S., and we have been ramping up those assets, and we are currently selling our ultra-pure acid to 2 of the chip producers, and we're working with all of those. So we are seeing a significant uptick in demand, and I think over the next 2 years we'll see even more rapid increase in demand as we sell out our new capacity.
Can you explain to us what it's used for?
Yeah, sure. So the final step of chip production, the fabs basically wipe off the computer chip with ultra-pure sulfuric acid, and that removes all of the impurities. And so right before it gets packaged and then shipped to their customers, they wipe it clean with ultra-pure sulfuric acid.
Interesting. Okay. Water treatment solutions, also part of your business, about 30% is what I understand. What's driving demand for this segment?
So what's driving demand for that? Well, I'll say over the past 5 years, we have more than tripled the size of our water treatment business. We've done that by adding capacity of new products, working on reliability and efficiency. We've also made acquisitions in this business. But as we look forward and think about growth in the business, tighter regulations across the market is driving growth. We'll see oil and gas has greater demand for water treatment. The poultry market and also data centers. Those are all industries that are demanding more water treatment chemicals.
Okay, what are the other products that your company produces?
Yeah, so in addition to that, we make sulfuric acid, and we supply that to the gasoline industry, oil and gas. We also make a group of products out of a plant, caustic soda, chlorine, hydrochloric acid, and we sell that into Canadian pulp and paper, water treatment, and then the fracking industry. And then finally, we make a product called sodium chlorate, and that is a bleach that gets sold to the pulp and paper industry.
So, Scott, because of the Middle East conflict and the fact that you make something that is added to fuel, has that part of your business dropped?
So that we are expecting that the conflict in Iran, as bad as this may sound, that could be an advantage for us. And so here I'll tell you why. In our electric chem business, 70% of our variable cost to produce our products is tied to electricity. And our plants for our electric chem products sit in Canada. And so our electricity is Canadian hydroelectric power. And so we compete with companies both in North America and with companies in Asia, and their electricity is a mix of natural gas and others. And so as natural gas prices go up and energy prices go up around the world, I think I like our position with Canadian hydroelectric power.
Interesting. Okay. I also know that net earnings were down $23.7 million in your last year. Why is that?
We have a turnaround. So basically, our largest plant takes a turnaround every other year. And so that's the number one reason for that our earnings have been off a bit. But if you look out over the past 5 years, we've had significant increase.
Interesting. Okay, let's talk about what's going on in BC. You've applied for rezoning for operations you have in North Vancouver, but that was rejected. What did you ask for, and then what is Plan B for you?
Well, so the Plan B, after the District of North Vancouver voted back in April, they did vote no. We went back to the table with the district members, and through negotiations, we made some modifications to our proposal.
What did you ask for, Scott?
The mayor supported us, and then they voted. They recently voted 5-2 to reconsider our proposals. And then, and that is moving to the next step, which is going to be next week on June 16th, that there will be more public hearings.
Can you outline what the request was for?
So the changes that we made were primarily tied into basically the issue of perpetuity, which is what the mayor had addressed. Our previous proposal was going to give us if we made safety upgrades at the site, then we were going to have approval from the district to operate and produce chlorine at that site in perpetuity. And so probably the biggest change that we made was tying that more in line with the length of our next lease agreement with the Port Authority.
Well, I was speaking with Scott Rook, President and CEO of Chemtrade. Up next, the SpaceX IPO is forcing investors to bet on Elon Musk's entangled AI empire as the world watches and waits for the historic IPO. There is a growing excitement around the burgeoning space economy, and it's increasingly favoring companies positioned to benefit not only from Elon Musk's SpaceX filing for a public offering, but also from rising enthusiasm in general to go out into space. For more, we're joined now by Bloomberg's senior defense and airlines analyst, George Ferguson. George, thanks as always for joining us. It's an interesting week with what lays ahead with SpaceX, eh?
It is. It'll be interesting to see how it trades and what the valuations are for the shares. So we're excited to see it get kicked off.
What are you looking at? What's your perspective on this? What are you looking at with SpaceX?
Yeah, so I mean, we've already, dig through the S1, and so we're starting to have a decent understanding of the business. And really, when you think about the business, it's three businesses put together. It's launch, it's a satellite constellation connectivity, they call it, and it's the AI business. And the discussion they're talking about, a valuation that could be $1.75 trillion to $2 trillion, obviously a huge valuation. And when we break it down and we think about sort of how it compares to market comparables today, we think about three-quarters of that comes from the launch business. We think about $500 billion of it probably comes from the AI business, and $700 billion of it comes from the connectivity business. But I think if you really think about the long term of this business, what we really see, and my colleague Mandeep Singh covers this, is that the AI business is the big opportunity here, right? I think we understand what the opportunities are for connectivity and launch, but AI is sort of the big unknown, heavy amount of investment, competing with some of the bigger tech companies in the world that are putting a lot of money into their infrastructure on AI. And so it'll be all about how investors are feeling about AI. And so I think that's going to also sort of decide how this gets traded in the marketplace this week.
So really, you think it should be treated as essentially as an AI company with a couple of things on the side here, more so?
Yeah, I mean, as much as it's called SpaceX, SpaceX revenue is about $4 billion in this, the launch business. But connectivity is $12 or $13 billion, and the AI business is $12 to $13 billion of revenue. So you could see the launch business is actually the smallest portion of the business. They don't account for internal launches there. But again, I think when you look at the runway for opportunity here, there's increasing demand for space, but it's just not going to grow like the AI business is going to grow. And I think the connectivity business, which is, it's surface of the Earth to a low Earth orbit satellite communications, it's broadband data. At some point, probably a lot more direct-to-cell connectivity where your cell phone connects to a satellite to make a call when you're in really remote areas. It's interesting, but it's just not going to grow, again, like that AI business. I think it's continued to be secondary to terrestrial providers of data and cellular communication. So to us, really, we think the long-term value here is AI.
Okay, we got to wrap it up there, but thank you very much for joining us, George. Bloomberg's senior defense and airlines analyst, George Ferguson. Opening bells are coming up next. There you go, the opening bells in New York and Toronto at the NASDAQ core bell, ringing the opening bell. At the New York Stock Exchange, it's the Honorable Scott Turner, Secretary of the U.S. Department of Housing and Urban Development. Getting to ring the bell there. And Toronto, it's quiet today. It happens every once in a while. Time now for the first 15. This is BNN Bloomberg. Trading is just getting underway. Let's check in on the equity markets and see how things are shaping up today. Now they're following the pre-markets today. You can see them all in the green, bouncing back after Friday. There was all having up days yesterday. It looks like that's going to continue. The TSX up by 0.37%. S&P 500 pushing back up towards 7,500. It's up by almost 0.6%. And the NASDAQ is up by 0.8% right now, well above 26,000. And taking a look, a couple of stocks worth mentioning here. TFI International, the trucking firm, getting a price target boost from BMO, $170 from $140, and BMO maintaining its market perform rating. Also, Bombardier is going to invest $78 million, expanding its Singapore service hub to support an anticipated increase in the number of next-generation business jets. It is off slightly today by 0.69%. One other note, though, I just want to about Bombardier, their jets, one of their private jets just set the speed record for a private jet from Montreal to Nice. They did it in 6 hours. I don't know if anybody south of the border is moving that fast, but we're going to find out. Jeff Morgan, the deputy team leader for the Bloomberg News equities team, is going to join us right now. Jeff, have you flown? Apparently, in its testing, that jet, I think it's an 8,000, hit a little over Mach 1, but they were averaging just under 0.95 Mach to get from Montreal to Nice. You fly that way all the time, don't you?
Oh, definitely, definitely. I'm not the kind of guy that gets too nervous over 110 on the highway. No, not me. Yeah, I fly that way all the time. You're right.
Okay, let's stay grounded here. And one of them is grounded right now, SailPoint.
SailPoint, yeah, really rough start for them. Earlier this morning in the pre-market session, they were down as much as 13%. And always, I guess, disappointing when your stock falls after you report better than expected quarterly results and also raise your full year forecast. So what's happening here is just really the market getting a little bit ahead of itself. This is one of these companies that was caught up in that SaaS apocalypse, software as a service apocalypse, as many traders were calling it earlier this year, where AI was expected to come and eat the lunch of all of these companies. So the stock is still down for the year, but it has staged a pretty massive 70% rally since its April lows. And in that rally, I guess it's gotten a little bit further ahead of itself. And so this morning, when they are coming out reporting better than expected results, raising their full year guidance, that's just not enough to kind of keep up with the rally that we've seen. So what we've seen here, adjusted income from operations, that guidance is raised for the full year. Revenue forecast, that guidance is raised for the full year. The first quarter results beat. But again, this is a stock where I guess, traders had gotten a little bit ahead of themselves. We've been talking about kind of exuberance in the market and the market that has just continued to push higher and higher, including for tech stocks, including for some of these software names that had been so heavily sold off into the April month this year.
And is that rising tide lifting all the software boats, or are some still anchored to the bottom?
Well, it had been. We had been seeing a lot of kind of resurgence in this tech name, but in these tech names. But now, as results are coming in, the expectations were just so high, and that's kind of the problem that we're seeing here. So, yes, we had largely seen kind of a big tech rebound, but now we are seeing, investors needing to weigh what's actually on the page, not just what's I guess in their hopes.
Hopes and dreams. Okay, United Natural. Their outlook disappointing.
Yeah, outlook is disappointing. This is another stock that's falling by double digits this morning. In the pre-market session, they were down by about 12%. And again, we've been talking about a handful of U.S. consumer-focused names that have been under some pressure, and looks like United Natural Foods is going to be another one of these. Yeah, so down 15% so far. And once again, this is not a case where the stock was under where the results were overly bad. What they did is they just reduced the top end of their full year guidance. So they reduced the top end, and that did bring, I guess, the midpoint of guidance below what Wall Street had expected it to be. So seeing net sales going just below the guidance as well. The third quarter net sales for the company also missed results by a little bit. And so those two things are really weighing on the stock. United Natural Foods, another one worth watching because, as I said, we have been watching a number of these U.S. consumer names for kind of a clearer picture of what the U.S. consumer is doing in light of inflation, in light of ongoing pressures, a low fire economy in the U.S., K-shaped economy, et cetera. Not a great data point here this morning. We've had a few kind of rough data points from the consumer names reporting.
All right, we're going to wrap it up there, Jeff, but thanks as always, sir.
Thank you.
Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team. Coming up, Apple hosted its Worldwide Developers Conference yesterday, but some are saying it failed to impress the investment community. More on that when we come back. Apple hosted its Worldwide Developers Conference yesterday. Our next guest says the company failed to impress investors, and he's not surprised by the sell-off in the stock. Let's get more now from Jamie Murray, president of Murray Wealth Group. Jamie, thanks as always for joining us.
Thanks for having me.
Okay, what left you unimpressed?
Well, I think we're just 4 years into this AI super cycle, and Apple still really doesn't have that coherent AI strategy that whether investors, like what Meta or Google or Amazon is doing, they're at least chasing that big TAM, and they're starting to generate tons of revenue, and they have tons of optionality. Apple now 4 years into this, they released a new improved Siri based on Google's Gemini models, but they're really not monetizing AI in any way. There's still questions how they're going to monetize it, and trading at 31 times PE ratio, for a very strong consumer brand, and not knocking Apple or the valuation at all. But, I think investors in this day and age are looking for where's the torque to the upside, and they didn't deliver that yesterday.
What would you like? What was missing, do you think, that from this?
Well, I think a lot of the other big tech peers, and now when you include the OpenAIs and Anthropics in there, they have consumption models that the more you use AI, the more tokens you generate, the more tokens you spend, the more revenue they're going to make. And so that's where you get that leverage. And that's how we've seen like Anthropic's revenue grow from, 5 billion to almost 50 billion in a year. And, we're going to see similar growth rates. We have the cloud business at the hyperscalers. So the Microsofts and Amazon's growing 30, 40, 50% on very large numbers. And we still don't really have that with Apple. Now, they're not having to spend the CapEx that companies are, which is the knock against these companies today. But I think when you look out 2, 3, 4, 5 years, there are some questions. Is Apple still just going to be a phone company? And is that still going to be the predominant way that information is shared and consumed?
All right. Speaking of AI and SpaceX, I mean, it's talking about space, but the name is space, but really, I mean, it's a lot of AI involved in it. What do you think of the IPO? Would you be interested in it? Will you be a buyer?
So I'm interested in it from a historic event that has never really happened, but it's not up our investment wheelhouse. It's coming public at 94 times revenue. Now, it's a very unique revenue base. Almost no other company in the world or no other company can do what SpaceX does. So it's extremely unique. I don't think the markets have ever seen anything like this company before, but at the valuation, it's still a very capital-intensive business. And we have a little report coming out later this week on why we're not buying the SpaceX IPO. I do think there might be a pop on the initial opening on Friday, just given low float, hot IPO. But I don't know how it's going to perform after that initial pop. So if you're not getting an allocation from the underwriters and flipping that in the first hour or 2 hours, I'm not sure how it's going to perform.
Do you think a lot of people are looking at it the same way as you, or is there going to be enough interest that it's going to go for what everybody's expecting?
I think you're going to definitely see interest. I've already heard it's oversubscribed. And I mean, like I said, it's a small tranche of the company that's being sold off. I think about 3 to 4%. So most of the holders are still going to be holding on and are subject to lockup agreements. But it's really just that we're in a market where growth at all costs has been rewarded. Betting on, the growth and the upside has paid off. Like if you look at what happened with NVIDIA, you look at what happened with, the Googles and the Metas 15, 20 years ago. I think that's what you're playing for SpaceX, just the unknown what if. But it's coming out at a very high bar in terms of the valuation. So, you're going to have to, it's going to be an amazing company to follow and watch, but we'll have to see how the returns are over the first few years before getting too interested in it.
And what about OpenAI? They're now starting the process for their IPO. Your thoughts on that?
Yeah, so OpenAI and Anthropic have filed their S1s, which is the document you have to file with the SEC to go public. We don't have the details yet on timing, financials. And like SpaceX, we assume that these companies are probably going to come out at trillion-dollar valuations. They're going to raise a small float, so just 3 to 5% of the company will come public. So that would be a $35 to $50 billion offering. And that money is going to go right back into data centers, into NVIDIA and Broadcom's pockets. So, good for those companies, definitely. But yeah, I mean, certainly, again, 2 other companies are going to be tons of interest. Like SpaceX, they've generated impressive revenue growth. They're actually growing even faster than SpaceX, I believe. So, we're excited to see what happens. We like the AI trade. We're invested through the semiconductors with NVIDIA and Broadcom, through the hyperscalers, so the Microsofts, Googles, Amazons. And I think now in 2027, we're going to see the downstream effects of AI start to show up in some, maybe old world economy companies.
All right, let's talk about some of your picks now. Uber, what are you liking there?
Yeah, so Uber is, I think, one of the best examples of physical AI that you can buy on the market right now. So physical AI is not just the thinking and machines in the data center spinning around and generating output. This is AI applications in the real physical world. And, you can see on the stock chart, it has not really participated in this NASDAQ rally at all. The underlying business is very strong. So the core Uber Eats and I need a ride home from work or the airport, very, very strong, growing 15, 20% a year, increasing free cash flow. Everyone is worried about autonomous vehicles and if really the Waymos and Teslas of the world are going to dominate the future of robotaxi. But we're doing some work on Uber, and we've discovered that they have partnerships with the numbers 3 through 15 in the autonomous vehicle space. And we think within 5 years, Uber is going to surpass Waymo in terms of number of robotaxis on its platform on the roads, and probably grow faster from there, just given their invested right across the ecosystem. And so Uber is a supply constrained company, meaning the more vehicles or delivery mechanisms they can have in their network, the more revenue they generate. And so we think this is going to be a huge unlock over the next 5 years. And it's a very cheap company trading at 19 times earnings.
All right, MasterCard is another one you're liking right now.
Yeah, so again, similar theme to Uber. So these are AI, companies we think are going to be benefit from AI that aren't trading like it. And again, you're buying MasterCard at a decade low multiple. And really, this is in the digital commerce. We're coming out of the cash to card movement where everyone had cash and then everything just went onto a card, and MasterCard and Visa benefited from that shift. We're moving into a very complex payments ecosystem. Is it going to be agentic? Is it going to be e-commerce? More and more digital. And MasterCard's network really sits as that layer of not just authorization and trust, but governance, consumer acceptance. And really, you need to have that layer, that intermediary between the buyer and the seller. And we think MasterCard and Visa are the natural companies to continue to dominate that space. And so we think MasterCard is going to continue to grow revenue, call it 10 to 15% for the next decade. When you put that into a discount cash flow model, you get a value that's 70, 80% higher than the current share price.
Okay, we got to wrap it up there. But Jamie, thank you as always for joining us.
Thanks for having me on.
Jamie Murray is president at Murray Wealth Group. Yesterday on Market Call, we were joined by Mike Vinokur. He's portfolio manager and senior wealth advisor at Propellus Wealth Partners, IA Private Wealth. He was covering North American large caps. His top picks were Microsoft, Colliers, and Expedia. Today on the show, we have Barry Schwartz. He is president and CIO at Baskin Wealth Management. His focus, North American large cap stocks. Just ahead, why WestJet is voicing its opposition to Ottawa's plan to support the airline industry as it grapples with record fuel prices. Only 3 days until Canada hosts its first ever FIFA World Cup men's game. And officials in the host cities, Toronto and Vancouver, say they are ready for kickoff. BC Place Stadium, where 7 matches will be played, underwent a number of upgrades and renovations to get ready for the games. CTV's Andrew Johnson has more.
To bring 43-year-old BC Place up to FIFA standards, provincial taxpayers have made a major investment. But one of the most noticeable changes in fan experience will be outside.
We're encouraging people to get here early. We're opening the gates 3 hours before kickoff.
That's because fans will need to contend with airport-style screenings at dozens of checkpoints, a level of security the head of the venue for FIFA says will be similar to the 2010 Winter Games. That's after already clearing checkpoints blocks away from BC Place to enter the stadium zone. At field level, crews are maintaining the multi-million-dollar Fraser Valley-grown grass pitch. UV grow lights are being used to help keep the pitch healthy, as well as tightly controlled in-ground irrigation.
Right now, the roof, we like to keep it open on non-match days. It helps the growth of the grass to get as much natural light and air circulation around the pitch. But likely on match days, it will be closed just to create that consistent environment, in particular for broadcast television.
The stadium's upgrades extend beyond the field. Nearly $200 million in renovations include a new video board, hospitality areas, and locker rooms.
This will be Canada's dressing room for their first match here in Vancouver.
And despite hotel and ticket prices well out of reach for most, the stadium is expected to be near capacity from start to finish.
We're very close to being sold out across all 7 match days here.
More than 50,000 fans are expected to fill these seats Saturday in front of a worldwide audience of 130 million when Turkey takes on Australia. Andrew Johnson, CTV News, Vancouver.
Coming up, it's not just SpaceX that is coming to the market. OpenAI is also planning to go public, and what could value the company right around that 1.8 trillion mark. We'll see. OpenAI has become the third major artificial intelligence developer to confidentially file for a public listing, joining rivals in an IPO pipeline. The company is working with Goldman Sachs and Morgan Stanley on a potential listing that could come as soon as the fall. For more on this, we're joined by Bloomberg's Seth Fingerman. Seth, thanks very much for joining us.
Thanks for having me.
Okay, do we have a better, I don't know, do we have any kind of a picture of what's next with OpenAI, what to expect from their IPO?
Yeah, we previously reported that the company could go public as soon as this fall. Now, I will say in their statement yesterday, they definitely hedge on that more and more explicitly than I think we saw with rival Anthropic. They had said that OpenAI said there's more that they want to do as a private company. So TBD on the timetable there. It's important to step back and remind that both OpenAI and Anthropic are incredibly capital-intensive businesses, and those capital needs only seem to be going up. So whether it's going public or raising another round of capital on the private markets, we should definitely continue to expect more financing activity from these firms in the coming months.
Is there a possibility we could see the IPO pushed back or even move forward, depending?
I think there's a lot of uncertainty around the timing here. There's how OpenAI feels about its business currently. We and others have certainly reported that this continues to be a heavily money-losing venture, despite the fact that it's a household name with nearly 1 billion users for its flagship chatbot, ChatGPT. So depending on where it thinks its bottom line is and how IPO ready it is, that could certainly play a role here. And then you have to keep in mind the larger market. SpaceX, as you said, is on the cusp of going public this week. If investors do not respond as well as expected to that, it could create a more hostile market for an OpenAI or Anthropic to go public, and that might change their timing. The flip side, of course, is if the market really thirsts for the SpaceX IPO, it's possible you see some of these firms try to move up and capitalize on that opportunity.
It really does sound like there's a lot of balls up in the air and a lot of guesses. It could go any direction depending on if this does this, that does that, this does that. How is this going to change AI development in general? These 3 IPOs, will we see something really go in a different direction when they go public?
Yeah, it's a good question. I think it's kind of a moment or even a seismic event in the industry. I mean, really, these are the companies that have led the way in AI for most of the past couple of years. And I think there's a couple of things to keep in mind. One, throughout the last few years, there's been this tension in the big AI labs over the pull towards commercializing their products versus the pull towards making them as safe as possible before rolling them out. And I think you've seen Anthropic and OpenAI wrestle with that in different ways. In a world where they have far more public stakeholders who expect a return on their investment, they might face additional pressure to get things out to market and faster and find new ways to monetize their services. OpenAI already seems to be doing that in many respects, including through advertising and subscription offerings. And then I think there's the question of what happens sort of to the next phase of AI. Will you see another new tier of AI startups emerge with new and novel approaches to this technology, or will you see OpenAI and Anthropic become so big that they kind of like snuff out parts of the market and kind of have more of a consolidation happening. We will see that in the coming months.
And it does feel like with their arrival, it says AI is here to stay. It's not going away.
Yeah, either way, I think this is a testament to just how much this sector has grown. They have a lot to prove still on sort of whether you can build a financially sustainable business. But Anthropic didn't exist 5 years ago, and OpenAI was barely known, 3 or 4 years ago. So to get to a point where these are potentially on the cusp of being trillion-dollar public companies is certainly a moment to take stock of how much AI has evolved.
And I guess there's so much talk about this. We also forget there is competition. China is developing AI as well. So this isn't a guarantee. Who are some of the relevant competitors to them?
Yeah, I mean, China has been very aggressive on trying to undercut these companies on pricing. At the moment, our sense is still that the best models in China remain behind the best models in the U.S. in terms of their cutting-edge capabilities, but that may not matter. Over the long term, you might see that just being able to offer a comparable model for less money could be enough to siphon away meaningful business from OpenAI and Anthropic as they go public. I think the counter take is supposed to be that if Anthropic and OpenAI kind of achieve an escape velocity, not just through the money that they raise, but through the capabilities of their models, which then make it easier to build the next model and the model after that, they can start to pull away and some more valuable work out there. But there's no question that there's a lot of competition abroad, and I think we're seeing more fundraising activity coming in China too.
Okay, Seth, we've got to wrap it up there, but thanks very much for joining us.
Thank you.
Bloomberg's Seth Fiegerman. And coming up, oil prices are falling as hostilities in the Middle East ease, and U.S. President Donald Trump signals once again that a deal with Iran may be imminent. Stay with us. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Canada's merchandise trade surplus grew in April to its largest in more than a year, driven by higher energy prices. The country posted a goods trade surplus of more than $2.7 billion, beating analysts' expectations. Exports increased by 1.6%, driven by the U.S. market. Canada now has nearly $9.5 billion surplus with the U.S. Bombardier is investing $78 million to expand its Singapore maintenance and service hub. It's to support an anticipated increase in the number of business jets. The private plane maker says there's a record backlog of orders surpassing $20 billion. A tenth of that is for the Asia-Pacific region. Construction will begin on the project in the second half of this year. Operations will start in 2028. OpenAI says it has confidentially filed for an IPO 1 week after its competitor Anthropic announced its plan to go public. ChatGPT parent says it hasn't decided on the timing and cautions it may be a while. It says some plans are easier to pursue as a private company. And taking a look at the markets, you can see the TSX rallying nicely today. It is back up over 34,700, up by 0.7%. And it's that chip rebound. It's the confidence in the markets. It's what we heard from the president. Similar situation south of the border. After that big sell-off on Friday, the market's rallying again. The S&P 500 closing in on 7,500, up by 0.75 point. And the NASDAQ well above 26,000. It is up 0.8% right now. And oil prices dropped this morning after a pause in strikes by Iran and Israel. U.S. President Donald Trump also renewing his claims that the conflict is close to an end. For more, we're joined by Ryan Bushell, Chief Executive Officer and Portfolio Manager at New Haven Asset Management. Ryan, thanks as always for joining us.
Thanks for having me.
All right. Oil prices starting to drop, although they've been hovering right around neutral. Is this legit? Do you think we're at the point where we might see oil start to drop?
Who knows? I find this whole thing pretty hard to fathom. If you would have told me a year ago that the Strait of Hormuz would stay closed this long and oil prices would be below 90, that would have surprised me. I think that the market is underestimating the physical nature of moving large amounts of crude oil and producing it. I think that there's a feeling in the financial world today, money moves so quickly, the touch of a button, at the behest of a tweet, that oil can just be, as soon as this conflict ends, and really there's no end in sight here, right? There's maybe a downshift and an upshift, and we keep going through that, but I don't think there's going to be a definitive end. So therefore, having complete normalization of the Strait of Hormuz, I think, is still a long ways off. And even if you got there, I kind of agree with Eric Nuttall when he says that maybe the best thing for oil is to open it right up and then see the reduced flows that actually occur, because I think the market believes that everything's just going to snap back to normal, and I don't think that's the case.
Even with, they have made adjustments. You've seen them manage to move oil overland, finding alternate ways to get that oil around. Also, people just scaled back. But the reality is, it's the big thing, I think, too, is the fact that reserves, a lot of places, their reserves are starting to run dry, aren't they?
Yeah, so it's the longer dated nature of this. That's exactly right. You've got storage tanks and physical storage levels in different areas of the world that are being depleted rapidly. China was well stocked headed into this, right? So China was doing a great job, very like them to be prepared, and was buying a lot of discounted crude oil from Venezuela and Iran and Russia over the past 3 or 4 years at very cheap prices, not market prices, much below market. So they were well stocked going into this, but again, this doesn't last forever. And the fact that this has gone on nearly 3 months now, again, with no tangible end in sight, I think we are getting to levels where you could just wake up one day and it's a shortage somewhere, or it's physical traders trying to get barrels and not being able to secure them, that just sort of sends the market a reality check here. And again, I'm not an uber bull on oil long term, but I do think, along with a lot of other consensus watchers in the space, that the floor is now higher, and we don't see a ton of new supply coming on. Venezuela did some things earlier this week on removing some clauses that would make investment more palatable there, but I still think that's a tough one for private capital to get into. I don't think you see private capital going back to the Middle East in the same way, meaning like non-state-owned actors. And Russia is having major problems as well on the production front and the distribution front. So we've got a lot of problems in the oil industry today, and that's before we talk about U.S. shale, which really hasn't responded to this crisis with a huge uptick in drilling. So I think that the floor price is higher, and it looks very good for Canada and Canadian producers.
All right, and just want to cut before we get to some of your picks. Gold is it's been trying to find its way through this crisis, hasn't it?
Yeah, it's interesting. Gold is another interesting asset today. We're seeing gold linked more with tech stocks right now than we are with inflation. Inflation is on the rebound. I saw consensus CPI numbers for tomorrow in the U.S. 0.5% with 4.2% year over year. That's getting back into hike territory. But the U.S. dollar's been strong through this as well, which has hurt gold. So I think gold's in a consolidation phase. It had massive gains in 2024 and into 2025. And I think you're in a consolidation phase. But ultimately, as I spoke with a couple of clients yesterday, I'm happy to hold it here and start picking away at these levels. We're not big gold investors. We own gold companies. We don't own the bullion. We want to get paid a dividend. But I think it's now a core asset in our portfolio. And I don't like owning gold. It means that there's things wrong in the world. But I think we're in a situation, as I said to clients yesterday, where we're going to see more geopolitical problems, not less, going forward. And I think, again, we have a huge stock market, call it a bubble, call it whatever you want, where potentially that leads to some sort of downshift. And what will be the response to that? We think fiat money printing, which is also good for gold. So I think it needs to be a core position in portfolios.
Okay, and let's talk about some of your picks. Agnico, that ties in with the gold nicely.
Yeah, so we're, like I said, we're picking away at it here for new clients. We bought our initial position in 2021, 2022 at the $65 level. So we're a long ways still up from there, but it's also a long way off the high, about $100 off the high here. And we want to have a core position in client portfolios of about 3 to 5%. So for clients that own zero, we think it's a good time to be picking away at the first tranche. And if you get maybe some sort of geopolitical event or tech-related flush downwards, either of which could create a flush downwards in markets, maybe you can pick off some more lower here or lower in a few months. But we're not counting on that because we do think the structural trend for gold is probably higher than it is today.
Okay, premium brand holdings.
Yeah, so again, kind of out of both of these spaces we're talking about, we still like good, solid businesses. We've talked about this a few times where Premium Brands was building up the ability to supply Costco in the United States. By all accounts, that's going really well. Their product is selling out. Their products are selling out. And so again, for us, it's not that different from a midstream or an infrastructure company where they need to build the infrastructure first and then start flowing the product through the infrastructure, and that should create a nice sustainable stream of revenue that's bankable for us as dividend investors. And this has been a company that's done a good job with its shareholders in terms of putting a dividend out there and increasing it alongside their results, and we think that will continue here. And this is a step change for them in terms of size of supply contract.
And we're almost out of time, but I just want to sneak in Tourmaline as a replacement. You're saying for ARC, of course, ARC sold. Yeah,
so we're not happy to see ARC taken away from us, but we think Tourmaline, we've always wanted to own Tourmaline and think it's actually quite discounted at today's levels. We talked about what potentially could happen on the oil side, but the natural gas side to us is much more positive. You're seeing a lot of news on the LNG projects in Canada. I think that will continue. The LNG side of this Middle East crisis is that there was way too much LNG concentrated in that area, and we think the world needs more secure points of supply, and Canada is one of the best possible points of supply if we can actually get something built, and I think there's now the appetite to do that.
Okay, we got to wrap it up there, but Ryan, thanks as always for joining us. Good to see you. Ryan Bushell, Chief Executive Officer and Portfolio Manager at New Haven Asset Management. Coming up, Ottawa is offering up to $150 million to domestic airlines in an effort to help them weather the impact of high jet fuel costs. But there are questions being raised by the industry over the effectiveness of this type of support and concerns for the cost of taxpayers. More on that next. Apple saw its stock go lower. Investors closely watching the iPhone maker's developer conference, where it announced a new AI-powered version of Siri. We got more from Gil Luria, Managing Director and Head of Technology Research at D.A. Davidson.
Apple would make progress in incorporating AI into its operating system, but they were dazzled, and I think there's still a level of skepticism that what we saw today will actually be available in its entirety, the way it worked smoothly in the demos. So we got what we wanted, but we're now skeptical or at least cautious about how quickly will all this functionality come out. And they've already told us it's only going to come out really in the US. It won't come out in Europe. It won't come out in China. And so the rollout in the fall is going to be more important. But having said that, what Apple showed today was they're starting to deliver on that promise of making AI a personal assistant. The main weakness for Siri has been that it wasn't incorporated into other applications. And that's what today's presentation was about, how they're using AI to incorporate Siri into other applications, into our contact, our calendar, our email, our messages, in order to carry out tasks on our behalf when we interact with Siri. If they can deliver on that, consumers will be happy and they're more likely to upgrade their iPhone.
Okay, so you can say to Siri, look at my last email from Joe Blow and tell me what he had to say about this, and it should be able to answer by pulling up that email.
And even do things like, if Joe, even without a last name, talked about a particular restaurant, can you book us a table in a week right before we go to the game together. That's the level of integration we want from Apple. That's what they demoed earlier today. So understanding the context of who you are based on your contacts, your calendar, your messages, and being able to execute tasks based on that context.
Okay.
If they can do that, it will feel like a personal assistant.
Siri is going to use Gemini to power some of what it will do. Is this a new opportunity for Google to gain some more strength against its competitors, OpenAI, Anthropic?
So I'd say it's better than them not being the provider for Apple, but the scope of this relationship is not nearly as good as the exclusivity they have in search, right? In search, when you go into Safari on your phone, into the browser on your phone, you search, you're automatically in a Google search and you see that it's a Google search. In AI, Apple put Google behind the curtain. They put Gemini behind the curtain. They're using a Gemini-like model behind the scenes, and they're using Siri as the consumer interaction. And so now you feel like you're dealing with an Apple application, with an Apple Search, Spotlight, Siri, even though it's powered by Google. So that's not nearly as good for Google. It also means that at any point, Apple can decide to swap Google out for OpenAI or for Anthropic if those have a better model, and ultimately introduce its own model or an open source model behind the scenes. Because if the consumer is habituated to dealing with Siri and with a Siri app, they're not dealing with Gemini, they're not dealing with ChatGPT, they're dealing with an Apple interface. That gives the control back to Apple, even though they are using technology that's currently coming from Google and Gemini.
Interesting. Okay. Apple's also introducing an agent that can update weak or compromised passwords across websites. What do you think of this? Does that technology or an app that does that already exist?
Security is a cat and mouse game. And the hackers keep getting better at finding our passwords and exploiting them. And Apple and Google Android and PC makers, Microsoft with its Windows, et cetera, have to constantly figure out how to outsmart those hackers. And this is a neat little tool that will be able to not just tell us if a password's been compromised, which it's been doing, but also fix it and replace that password. So next time we log in, we'll still be able to log in using our device in spite of the fact that the password had changed. So it's a neat tool that the mouse that is the hackers will figure something else out, and the cat that is Apple, Google, and Microsoft will have to figure out something else down the road as well.
Okay, so we talked about the updates to Siri, we talked about passwords. Was there anything else that impressed or stood out for you from the conference today?
That they mentioned that the AI models are going to run on device. This is very significant. Up until now, almost all AI that we use, all the tools that we're using, are hosted in a cloud, in a data center. The more functionality they can put into the device, the faster it's going to work, and the more the data centers are going to be there to deliver more computationally intense requests, and that'll make the consumer experience a lot better. And they demonstrated that with photo editing. They can do a lot of the photo editing, even though it's AI enabled, on the device. And only when you're done and you want to render the image, the complete image, will it go to the cloud to do that. So that's a very big step for Apple and for AI, that you can do more of this functionality on the device.
You've maintained a neutral rating on the stock. Are you waiting to see if they can deliver after that initial rollout in the fall?
And more importantly, if this drives iPhone adoption. We are in the midst of a big iPhone upgrade cycle. With double-digit growth in iPhone sale this year, it comes after 4 years of stagnant growth. The bad news about a big upgrade cycle is that you always have the next year where you're comparing against a big upgrade cycle. So if this AI functionality is not enough to drive another upgrade cycle or an extended upgrade cycle into next year, we may see negative growth in iPhone next year. And that's a risk we don't think investors have fully reflected yet.
That was Gil Luria, Managing Director and Head of Technology Research at D.A. Davidson. Well, only 3 more sleeps until Christmas for soccer fans, at least football fans. FIFA World Cup 2026 kicks off in Canada and across North America. The global sporting event should be a cause for celebration. likely bringing along a little bit of a rise in celebratory drinks. For more on the hype as we get closer to kickoff and the boost to Canadian cities for the increase in alcohol sales, we're joined by CTV's Renee Rogers. Renee, how are you? I think everybody's ready for the party. How big a party is it going to be?
Hi, Roger. Good to see you. Well, with the FIFA match being the first one on Canadian soil being 3 sleeps away, as we're now referring to it, there is a buildup of excitement and a buzz in both host cities, Vancouver and Toronto, as they make their last-minute adjustments to their stadiums and their final preparations to welcome the world. So tomorrow, a countdown concert is on, being hosted in Toronto ahead of the first day of its free fan festival, for which 16,000 tickets each day are being made available for free to fans. And then as we get on to Friday, Canada will play its first game of the tournament at Toronto Stadium against Bosnia and Herzegovina. And then on Saturday, BC Place will stage its first match between Australia and Turkey. But Roger, despite the hype in these two host cities, not everyone is on board with the estimated price tag attached to these games at more than $1 billion. New data from the nonprofit Angus Reid Institute shows today 7 in 10 residents in both Greater Toronto and Metro Vancouver say the public costs are not worth the trade-offs. At issue for them are things like disruption, street closures, the lopsided amount of revenue they say that FIFA will be taking, and a rearrangement of their city's summer cultural and event calendar. But then on the other hand, Roger, host cities say that they're counting on a massive revenue boost during those games, with FIFA's own projections suggesting that the tournament could contribute as much as $2 billion to Canada's GDP due to global exposure, visitor spending, and general economic activity. So really, whether you're excited or in counting the sleeps on this, it really depends on how big of a fan I suppose you are, and whether or not you think that this is going to disrupt your summer in either of the host cities.
It's a tough call. I mean, from the advertising point of view and the cost, you look and go, well, if we get people wanting to come to Toronto and Vancouver and the rest of Canada, I mean, maybe it's money well spent, right?
Well, exactly, Roger. That's just what it is. But then, of course, we've got, the parliamentary budget officer putting out, releases saying that it's going to be costing more than $1 billion for Canada. So certainly people there's kind of a both sides to this argument, you could say.
But it's coming. All right. CTV's Renee Rogers. Thank you for that.
You're welcome.
Okay, Canada wants to lend domestic airlines up to $150 million in an effort to help them weather the impacts of high jet fuel costs, all part of the closure of the Strait of Hormuz, which sent oil prices spiking. Joining us now to explain the motivation for the loans and how effective they may be, John Graddick, faculty lecturer in aviation management at McGill University. John, thanks as always for joining us.
My pleasure, Roger.
Okay, what's the reasoning behind this offer of a loan?
I think the government is trying to stay one step ahead of financial difficulties that the airline industry it looks to be facing over the short term as a result of the Strait of Hormuz continuing to be closed. They've seen the impact of these high jet fuel costs on carriers south of the border. When you see Spirit Airlines shut down, 140 airplanes, 17,000 employees, they declared bankruptcy in the space of a week as a result of these high fuel costs. So I think the government is saying, let's stay one step ahead of that eventuality in Canada, and let's make sure we have some money set aside to help carriers to weather this fuel expense.
And do loans like this help? Do they work?
Well, they tend to work if you look at, making sure that the money is spent to, in fact, ensure cash flows and ensure, continued operation. They tend to be, Band-Aid solutions that are short-term in nature. The question about aviation fuel is one that's going to be haunting the industry for quite a few years ahead of us. We're never going to go back to the days where we had, fuel at $60 a barrel US. Those days are long gone. We're probably going to be somewhere around $100, $120 a barrel for fuel at best. And, we have, if the Strait of Hormuz stays closed, we have forecasts that have fuel at $200 a barrel, even higher than that. So, once fuel hits $200 a barrel from its current level, about 130, 135, the industry is going to be in deep doo-doo, as they say. And we're going to be in a question of trying to figure out which carriers are able to survive the cat.
That's an aviation term, clearly. Is 150 million enough?
It should be enough for a carrier like, pick an example, Porter or maybe Air Transat. For carriers like WestJet, carriers like Air Canada, it's basically, week or two. These guys.
Sorry, John, you just cut out there. If you could just repeat what you said there. You just cut out.
Yeah, no, for the WestJets of this world, for the Air Canadas of this world, 150 million is a drop in the bucket. When you're talking to carriers like Transat or Porter or Flair, it is big dollars. So depending on the size of the airline and their consumption of fuel, it may or may not be interest. So WestJet basically has already said not interested. They'd rather see that money directed towards reform in the aviation industry, which is a valid comment, but I think the government is addressing a short-term cost issue that has to be addressed and has to be done.
Yeah, I wanted to ask you about that WestJet comments that said we do not take government loans, instead advocate for a competitive environment where airlines can succeed based on their own strength. But are they looking a bit of, it's not a gift horse entirely, but are they looking a gift horse in the mouth at this moment? And are these not two separate issues?
Yeah, they're two very separate issues. I think at WestJet, is saying let carriers go bankrupt. They can't make their way through this process. And one less competitor to worry about. And I think that's not the way we should be operating airlines in Canada. We need to have airlines operate competitively. We need the infrastructure in place to support the airlines. So WestJet's comment about reform in the Canadian aviation industry is very oblique. It's not very, very detailed in terms of what they want to do, rather than just saying a blanket statement, we need to fix the airline industry. So I think there's going to be a need for some discussion with WestJet. They want us to do.
I was going to say, where's that comment coming from then? Like fairly open-ended. I'm guessing there are concerns, but it does seem like they run the risk of offending some people.
Well, yeah, I think that they've been on this kick for a year and a half. I think the president and CEO of WestJet has been on this bandwagon to reform Canadian industry. I think he wants to look at less costs. He wants those AIFs that we pay every month to be somehow, some way redistributed to the Canadian taxpayer, rather than having users pay for airports. Let Canadian taxpayers pick it up, which is not going to be the case in Canada. I think he's against the APPRs, the air passenger protection rights, that are sorely needed to be updated in Canada. And I think WestJet's saying, we don't want these APPRs. We don't need protection for passengers. We're protecting the passengers as best as we can, and that's not good enough. So there's a lot of issues that WestJet's been complaining about in terms of government oversight that I think are just wishful thinking.
All right, and then a bigger picture. Are we at the risk of more flights being canceled over the next few months if this drags on?
Yes, we are. I think that we've had a conversation about aviation fuel supply. That's been a concern in Europe and in Asia. That seems to have been addressed by carriers, kind of looking at different ways of saving fuel, and countries importing fuel from different locations other than the Strait of Hormuz. So I don't think we're going to have a fuel supply issue. The question is going to be price. And as much as the airlines have said they protected themselves through hedging fuel prices over the next few months, this is not a long-term solution. You need to basically come up with a better way of managing your costs and managing your fares. So I think we're going to be in situations where carriers will be rationalizing their air services, canceling flights that don't make any sense, that don't make much money, and only operating those flights because they feel that have a chance of some profitability.
Okay, we have to wrap it up there. John, thanks as always for joining us. Appreciate it.
My pleasure. Have a great day, Roger.
Cheers. John Graddick, faculty lecturer in aviation management at McGill University. Coming up in the ETF report, going beyond the Magnificent Seven, we'll have 3 themes from the physical build-out behind AI right after this. Time now for the ETF report as the AI boom continues to power both the markets and the economy. What's the best way to benefit beyond the Magnificent Seven? We've got three AI infrastructure themes for you now. Joining us is Sean O'Hara, president of Pacer ETF. Sean, thanks very much for joining us.
Good morning. Thanks for having me.
Okay, you see money continuing to flow into international and quality names with the weighing the U.S. valuations. Where does the AI infrastructure fit into that?
Well, so you have to kind of keep in mind that the die has sort of already been cast. The hyperscalers have committed to spending somewhere between $3 and $5 trillion to build out AI capacity. If you think about AI, it's really there's three legs to the stool, if you will. One is infrastructure. Those are the data centers. Two is compute, which is, the large language models and these big databases. And then three is energy. Where's the source of energy going to come from? So the three tickers we gave you today, we'll start with the infrastructure. That ticker is Server, SRVR. That owns the publicly traded names that are specializing in building out and managing these data centers. So you can think of names like Equinix or Digital Data. Recently, we added a little sleeve to that we call sort of, real estate, I lost the word there, but when we launched that product, Server, about 8 years ago, the reason for doing so was based on the cloud, not necessarily AI. And with AI, the big bottleneck is going to be where they're going to get the power. It can't come from the grid. And so we added a little sleeve in that portfolio that we call behind the meter on-site power generation. So you can think of like gas turbines, that would be GE, Vernova, or Caterpillar, or Rolls-Royce. Most of those will be powered by natural gas. And then longer term, there'll be some small nuke names that'll participate. So the infrastructure part of that is the data centers, that Server. Off of the success of Server, what we said is what really makes the buildings really valuable is everything inside. So you can think of that as software, hardware, networking, chips, cooling systems, if you will. So we pulled everything out of the data center. We put it in the parking lot and put it in piles, if you will. That ticker's TRFK, traffic. The game we're playing with, the name is moving data around. And so that's really where that compute is going to come from. It's going to come from everything inside the data center, as I said, from like hardware, software, networking, chips. And then data centers are pretty particular buildings. They have to operate in a high cool environment. So they need massive cooling systems. And so we include some of those names. And then the last piece of the sort of the journey is the energy. And we think the energy is going to come in the short run from natural gas. And so we have a natural gas ETF, USAI, that owns the pipelines and the gas producers. And that's where we think the first wave of energy power is going to come from. And so there's a little three-pack there for you, Server, traffic, and USAI, where you can sort of cover the AI story end to end, but on a particular side of the street. The hyperscalers are going to be the spenders. They're going to commit the money with regard to CapEx. That money is going to go to all three of these players that I just mentioned. It's going to go to build out data centers. It's going to go to buy all the equipment necessary inside of a data center for it to operate. And then ultimately, it's going to be invested in more pipelines and more natural gas production in the short run. And then obviously in the longer run, it's going to be small nuke.
All right, we've got some competitors I just want to pull up and ask you a couple of questions. DTCR, they have semiconductors and AI hardware exposure. Staying away from that?
No, it's a part of the traffic story. I think there's a long way to go in terms of, we had a little pullback. That's just natural in the market. But, when you think about that $3 to $5 trillion spend, half of that money or more is going to go to buying the equipment, and the chips are going to be a big part of that. And it's just not the NVIDIA chips. The NVIDIA chips are GPUs. That's sort of moving data around, if you will. The memory chips are also going to be a big part of this. And there's sort of a bottleneck there as well. And so, you had names coming out that, and then you have sort of the server part of it, the physical server. That was Dell's announcement a couple of weeks ago where it went wild. Micron has obviously moved up. Intel has moved up. So I think we're still fairly early in this game.
Okay, yeah, because
But what's different about traffic than some of the other names, like the one you managed, is it's not just focused on the chips. It's everything else. There's going to be a big flow of money going into buying all this equipment, and it goes far beyond just chips. It goes to cybersecurity names like Snowflake, for example, or it goes to the chip makers, whether that's NVIDIA or Micron or AMD. And then there's networking and software solutions included as well. And then don't forget the cooling piece of it. So you've got names like Trane, for example, and Johnson Controls in that portfolio that keep those buildings cool.
Because I'm just looking at DTCR has outperformed year to date so far, but you think it's going to play catch up now?
Well, I think servers up about 20-something%. Traffic is up, I don't know, 60 or 70%. So I still think there's a long way to go in terms of the opportunity to be on the right side of this equation. We don't know whether Meta or Google or Amazon's going to be able to make money operating these data centers, but we do know that they are going to spend the money, and the companies they're going to spend the money with today are profitable doing what they're doing.
All right, we got to wrap it up there, Sean, but thanks as always for joining us.
Thank you so much.
Sean O'Hara, President, Pacer ETFs. Coming up, we'll get some insight on the loonie and how it's pricing in tomorrow's POC rate decision. Stay with us. All right, welcome back. My next guest says the loonie is being pulled by a strong U.S. dollar, especially in the near term because of the macro backdrop. Let's find out what the prediction is for the loonie in the third quarter of the year. Joining me now is Mark McCormick, Chief FX Strategist at BMO Capital Markets. And thank you very much, Mark, for joining us.
Thanks for having me.
All right, let's get it out of the way now. Where do you think the dollar's going, and how's the U.S. dollar, the greenback, driving it?
Yeah, so there's a lot of things in motion. There's a lot of uncertainty, complexity, but at the end of the day, there's divergence between the respective economies of the U.S. and Canada. And I think it comes down to there's a growth story, there's an inflation story. There's obviously the focus around energy in terms of trade that comes through in the Iran conflict. But at the end of the day, the U.S. is an economy that's got strong growth and high inflation. We should see the markets probably be surprised again by a hawkish Fed. I wouldn't be surprised if the Fed actually delivered a hike at some point in the fall. And the flip side, you basically have a Canadian economy where, again, it probably cannot handle higher rates, although there's the need potentially to remain on hold, but they probably can't cut rates, which is probably the direction they'd like to go because inflation's a little bit too high relative to where they'd like it to be. So at the end of the day, what you have is the FX markets reconnecting back to rate differentials. And there's a clear divergence story that should take the dollar CAD through, or the Canadian dollar below 71 cents at some point.
And is that and that's pretty much what's been driving, because with oil, normally the dollar kind of rides along with the oil going up, doesn't it? The Canadian dollar.
I think it's one of the myths I think that's quite important. It's like at the end of the day, what the Canadian dollar is really correlated to is risk sentiment. And so sometimes when the equity markets are going up and oil's going up, that's a risk on trade, and that's when the Canadian dollar does well. I think what people need to kind of disentangle from that is when equity markets are in a certain direction, there's volatility, and oil is driven by supply side. That's not necessarily a good thing for the Canadian dollar, or at least relative to the U.S. dollar, because the U.S. is also an oil producer. It's good for the Canadian dollar on crosses. It's good for the Canadian dollar relative to Europe and Asia that are natural gas and energy importers, but it doesn't move the needle for dollar CAD, I think, the way people thought it did. So that is one of the strongest things I like to push back on, that it's like oil goes up, it's automatically bullish for the Canadian dollar.
So what would be a change that might have an impact? Is it a resolution in the Middle East, or is it our economy? It's to strictly strengthen the economy. What might be an impact over the next 6 months?
So I think in the next 6 months, what you kind of need to see is there definitely needs to be a pivot. You need to see, I would say, a pro-growth environment that sees capital either kind of coming back into Canada, or, again, markets in Canada starting to outperform. I think the big challenge when you think about the currency market is you always want rate differentials. You want to pick up carry. You want to look for places where there's growth and strong equity performance. And in this environment, again, you're dealing with terms of trade shocks. So you want to buy countries of currencies that essentially have energy dependence in terms of becoming an exporter or not an importer. So when you line those things up, they're all just in favor of the US dollar. So I think for the things that have to change is the Canadian economy really needs to start firing on different cylinders than it has for the last couple of years. So again, maybe that's a rotation away from a housing-based economy, from back to an energy-intensive economy. Again, it could be part of the infrastructure build-out that Carney's pushing, trying to get pipelines moving east to west. I think those are the things that you're laying the groundwork for, where maybe the economy is bottoming out and the currency is a reflection of that. But I still think for the next 6 months, the story is really going to be about the strength of the U.S. dollar, its potential Fed hikes, it's the outperformance of U.S. equities, and it's the carry you pick up in the U.S. dollar. So I still think it's going to be generally a U.S.-driven market, but I think those conditions can change into 2027. But a lot of it's going to hinge on whether or not the government can pull off this infrastructure build-out and basically turn the economy back into an energy producer.
And are we seeing any signs of that? I mean, the last 2 quarters, GDP was weak. You know, we're right around whether it's you want to call it a recession or not. But within all those numbers, were there any indicators that maybe there's some wheels starting to turn somewhere in the back there?
I think the best way to think about it is sentiments changing. I think conversations we have with clients globally, there's a lot of questions around, you know, what is Canada going to do to kind of revitalize the economy? Again, there's a lot of discussions when you think about what the problem is in Asia. The countries in Asia, Japan, Korea, they have an issue where they need natural gas. That is also a thing that Germany needs. So one of the potential outcomes from the conflict of Iran is a rebuild around natural gas. And Canada, if they can kind of, again, are realigning themselves as more of an energy producer and producing and selling natural gas from different parts of the country, whether it be the East Coast and West Coast, they can fill that void. So I think the sentiment around this conversation is starting to change in a more positive direction. But again, the data right now is just not on the Canadian dollar side. It's not on the Canadian economy side. And that's probably going to be where we are for at least the next couple of months. But as sentiments start to change, psychology changes, and then markets start to price that in. But again, I think that's more of a 2027 story, and it's not one for this year.
Okay, we got to wrap it up there, Mark, but thanks very much for joining us.
Thanks for having me.
Mark McCormick, Chief FX Strategist at BMO Capital Markets. Coming up, Hot Picks will zero in on 3 plays in banks. All right, let's take a quick look at the market, see how everything's settling in on this Tuesday. After that rough end to the week, it's been a positive week this week. And same thing. Oh, no, actually the TSX, when I looked last time, it was up. It's now taking a bit of a turn. It's off by 0.3%, being dragged down by the energy index. Let's take a look at one stock, though, that we were talking about today, Bombardier, making an announcement that it's going to expand its Singapore hub there, build a new one there. $78 million is what they're going to invest on, about 100 million Canadian. The maintenance and service hub that they have there, because they're expecting a big increase in next generation business jets in that region. There's a $20 billion backlog for Bombardier. That's what they reported in April. About 10% of that is from the Asia Pacific region, so they're going to need that hub there. And right now, it's down by a 1/4 point. I just want to throw in one other note about Bombardier. I was fascinated by this one. Their Global 8000 jet just set a speed record flying from Montreal to Nice, France, in a little more than 6 hours. Has a top speed of 0.95 Mach. And it actually has gone above the speed of sound a couple of times when it was doing its test. But put it in perspective, the 787 Dreamliner that most of us would take, average of 7 hours and 45 minutes to go from Montreal to France. So that plane was flying south of the border. Taking a look at the markets down there. And you can see everybody's had a dip right now after starting off on the green side. You can see the turn that's happened in the last hour or so. The S&P 500 off by 0.6, and the NASDAQ is down by about 1.1. One of the big hits today is Marvell on the NASDAQ. I mean, it's been soaring lately, but look at it right now. It's off by about 6.5, 6.75%. Investors taking some profits after that big rally that pushed the stock far above its key technical support levels. And still, though, the long-term trend remains firmly intact. The stock having surged over the past 12 months, still trading above all the major moving averages. And coming up, we'll be right back after this break. Chemtrade Logistics, the Canadian industrial chemicals company, is a leading supplier to global makers of advanced semiconductor nodes. It also supplies water treatment chemicals to more than 1,000 cities across Canada and the U.S. The company expects these segments to be key drivers of future growth. For more on it, we sat down with Scott Rook, President and CEO of Chemtrade.
We have recently upgraded our quality levels at 2 out of our 3 ultra-pure acid plants in the U.S., and we have been ramping up those assets, and we are currently selling our ultra-pure acid to 2 of the chip producers, and we're working with all of those. So we are seeing a significant uptick in demand, and I think over the next 2 years we'll see even more rapid increase in demand as we sell out our new capacity.
Can you explain to us what it's used for?
Yeah, sure. So the final step of chip production, the fabs basically wipe off the computer chip with ultra-pure sulfuric acid, and that removes all of the impurities. And so right before it gets packaged and then shipped to their customers, they wipe it clean with ultra-pure sulfuric acid.
Interesting. Okay. Water treatment solutions, also part of your business, about 30% is what I understand. What's driving demand for this segment?
So what's driving demand for that? Well, I'll say over the past 5 years, we have more than tripled the size of our water treatment business. We've done that by adding capacity of new products, working on reliability and efficiency. We've also made acquisitions in this business. But as we look forward and think about growth in the business, tighter regulations across the market is driving growth. We'll see oil and gas has greater demand for water treatment, the poultry market, and also data centers. Those are all industries that are demanding more water treatment chemicals.
Okay. What are the other products that your company produces?
Yeah, so in addition to that, we make sulfuric acid, and we supply that to the gasoline industry, to oil and gas. We also make a group of products out of a plant, caustic soda, chlorine, hydrochloric acid, and we sell that into Canadian pulp and paper, water treatment, and then the fracking industry. And then finally, we make a product called sodium chlorate, and that is a bleach that gets sold to the pulp and paper industry.
So, Scott, because of the Middle East conflict and the fact that you make something that is added to fuel, has that part of your business dropped?
So that we are expecting that the conflict in Iran, as bad as this may sound, that could be an advantage for us. And so here I'll tell you why. In our electric chem business, 70% of our variable cost to produce our products is tied to electricity. And our plants for our electric chem products sit in Canada. And so our electricity is Canadian hydroelectric power. And so we compete with companies both in North America and with companies in Asia, and their electricity is a mix of natural gas and others. And so as natural gas prices go up and energy prices go up around the world, I think I like our position with Canadian hydroelectric power.
Interesting. Okay.
All right, well, I was speaking with Scott Rook, President and CEO of Chemtrade. That wraps up this edition of The Open. Morning Markets is next.